there is a demand for progressive wealth taxation. What you see is that 60, 70% of the electorate in the US, according to these opinion polls, is in favor of a tax such as the tax that was proposed by Senator Elizabeth Warren, tax of 2% above $50 million, 3% above $1 billion. The number one argument for why we might want a wealth tax in the US is wealth is concentrated. There's a lot of wealth at the top, can generate a lot of revenue to fund education, healthcare, and so on. Question is, will it work? And more importantly, how can we make it work? These are policy choices. So sometimes governments choose to let taxes fail, but they can also choose to make taxes work. And with good fiscal plumbing, I think the United States would be in a good position to make a wealth tax work. So what's the European experience with wealth taxation? Let me be very clear with the fact that this experience was a failure. Europe has and still embraces tax competition. France used to have a wealth tax, and a French person who wanted to avoid the wealth tax could simply move to London. Second problem is tax evasion. Until very recently, there was no exchange of bank information between banks in Switzerland, in Luxembourg, in tax havens at the very heart of the European Union. So you open a bank account in Switzerland, you have a bank account in Luxembourg, and if you don't self-report your wealth on your wealth tax return, there you go. Third is the way that these taxes used to work, and in some countries still work. These wealth taxes started very low in the wealth distribution, typically around $1 million in net wealth, which over time generated lobbying from taxpayers who said, look, I just have a house or a small business. I'm not liquid enough to pay for the wealth tax. The US context today is very different. The US is in a much better position today to make a wealth tax work. You leave the US, you have to continue paying taxes in the US forever, because taxation is based on citizenship, not on residency. Both the Warren and the Sanders wealth tax plans, there is a stiff exit tax for citizenship renunciation, the idea being always the same. You've built a $100 billion fortune thanks to US markets, in particular, and US infrastructure. Now you want to leave the country, in the Warren wealth tax, you have to pay 40%, $40 billion. The US receives information from foreign banks. That's a major achievement, tax policy change during the Obama administration. Virtually all tax havens and foreign financial institutions have agreed to cooperate. I'm not saying it's working perfectly, in particular because IRS budgets have declined so much that these FATCA reports are not used in a systematic manner, but with more budget for the IRS, these FATCA reports could be matched automatically to income and wealth tax returns, making it very hard for wealthy people to hide assets abroad. The last difference is the very high exemption thresholds in the current wealth tax proposals: $50 million in the Warren wealth tax, $30 million in $32 million in the Sanders wealth tax. It's obvious for everybody that someone who has more than $50 million, let's say someone who has $100 million, will always be able to pay $1 million tax, which would be the tax bill for that person under a Warren tax. And so it makes these taxes much less vulnerable to the type of lobbying that eventually undermined the tax base in Europe. Now, to make the tax work in the US, there are a number of important points that will need to be taken into account. It's very important, that's another lesson from the European experience, to tax all assets at their market values. Now you're going to tell me some assets don't have market values, and my answer is going to be create a market. That's how you create market values. So concretely, you own shares in a big unlisted company. The IRS could use valuation methods that exist in the private sector to put a value on these shares, on these assets. And if the taxpayers are unhappy with the IRS valuation, they would have the option to pay in kind with shares of the company. And then the point is not for the government to own shares in private businesses. The point is for the government to sell the shares on a market, and in effect to create the market that currently is missing. So create market values. Last is there is tax avoidance. Regulating the tax avoidance industry is a choice. Okay, and much more could be done. You could create a public protection bureau, for instance. That's a proposal we make in the book that would make sure that any new tax dodging product is automatically reported to that agency, and any tax avoidance scheme that violates the economic substance doctrine is automatically outlawed. Is it worth all the trouble? Look, there are many ways to collect more revenue from the very wealthy. But the wealth tax is the most direct and powerful way to tax the very, very rich. And when I say that, I don't want to say that we shouldn't close loopholes, we shouldn't have a more progressive income tax, we shouldn't fix the corporate tax. We should do all of these things. But these things would not be enough to make billionaires, to significantly increase the effective tax rate on billionaires. You take the case of Warren Buffett. According to Forbes magazine, he's worth $80 billion. His true economic income is something like 6% of his wealth, around $5 billion. His taxable income, what he reports on his tax return, we know that because he makes that public, is of the order of $10 to $20 million. What's the reason for this? He's the main shareholder of Berkshire Hathaway. He instructs Berkshire Hathaway not to pay dividends, 0 dividend payments. And then his only taxable income is when he sells a few shares each year, and he pays a little bit of capital gains taxes on that. So if he realizes $10 million in capital gains in a given year, the capital gains tax rate is 20%, he pays $2 million, his effective tax rate out of his true economic income is $2 million divided by $5 billion. This is 0%. You can increase the top marginal income tax rate to 99.9%. It will still be 0%. Corporate income tax can address some of that problem because corporate profits, that's income that's taxed, whether it's distributed as dividends or not. But it's a too crude an instrument because it's a flat tax rate. So this is just an illustration of how the Warren wealth tax, for instance, would change tax progressivity at the top end. So today, when you distribute 100% of tax revenue in the US across the population, taking into account all taxes at all levels of government, you get a very mildly progressive tax system that becomes regressive at the very top, with the top 400 richest Americans paying about 23% of their income in taxes for the reason that I mentioned. With the Warren wealth tax, you double that to 46%. And let me just finish with this. Before 1913, you have rising inequality. You have a very unfair tax system. The only federal tax is the tariff, highly regressive. That's the context in which there's a growing demand for progressive income taxation. And then you read, many contemporaries, including distinguished economists, before 1913, and what do they say? Progressive income taxation, it will never work. And of course, it was unconstitutional. And the Constitution changed in 1913, and the top marginal income tax rate increased to above 90% in the middle of the 20th century. And I think that everybody today agrees that the federal income tax is a huge success. If collectively, if governments want to make taxes work, if there's a demand for redistribution and more progressive taxation in the population, that's something that can be done. Thank you very much.